Alright, so we are back with our new episode. Uh, New episode after some technical issues that we've met this week. However, I will try to make you up those belated updates and eventually give you out the very good pill of the most updated informations. So we are back with economy. If my microphone at first hasn't worked properly, I've switched it on and it should be fine right now. So we are right now heading into economy view, and for this one to happen, I'd like to show you out the very important chart of today, as we have Fed's decision, the Fed rate market implied versus forecast, showing that higher than expected US inflation numbers for August cemented expectations for another jump rate increase from the Fed. So some worry that this process, in which the Fed cut by 95 billion per month, could hurt market interest rate are about to peak even even higher levels in the worst case, and that will be devastating for the economy in terms of eventual defaults, as right now we are struggling with exponential more debt in the system, and cost of carry is skyrocketing with unprecedented velocity. That's why whenever we see such chart of the 10-year treasury yield, this might be a harbinger of recession. We are reverting the long-term trend of lowering interest rates on 10 years. Right now we are reverting this, as it would be kind of a by getting transitory inflation wrong, and right now they're trying to make it up by keeping and hiking interest rates with a rapid fire attack. Will it be 100 points at this time? I don't think so, but Fed will do everything in order to slay the inflation. For 25 years Fed saved the market, but this time it will maybe even sacrifice valuations in the name of slaying this problem. So how to withdraw from hiking policy when we reached that far? For now we are participating in a competition to see who can hike faster. About 90 central banks around the globe has decided to hike by at least 75 basis points in one shot, and even Sweden has recently hiked by 100 points. That hasn't been depicted on this exactly image, as Sweden made it as of very recent. So despite that many interest rate hikes by many central banks, it's USD that is gaining its purchasing power, as this risk of environment is to persist longer. This chart is quite anxious. Change new home sales versus recessions, and whenever we had such a slump below minus 10% territory, that was a foretelling in a high expectations a recession. The only one exception from this was back in 60s, but the situation in the economy back then was also kinda different. So it may it may bring us the view that this recession is unavoidable. Dire housing data, United States NHB Housing Market Index, showing that we are right now in a recessive environment, and that's something that is kind of one of the most important lagging indicator of a oncoming recession. That's why we should be bothered of what may come next, and that has boiled down to this very large supply of houses on the market back in January of 2022, and right after 6-month change in months of supply, we have found that price have fallen, and this also brings us to conclusion that it may take even next couple months for this one to calm down. So it's not only the US that is suffering from lowering home prices, that's the global trend in everywhere, nearly, whether it's Europe, Australia or America. These problems are nearly everywhere. Especially the problems we are observing right now in the EU. Many companies struggling with the new fiscal environment, and EU's rocketing energy bill gets even to over 75% in July August. So many companies may possibly go bust with that prognosis, and this is the nature of a crisis, where the strong getting stronger and weak getting weaker. That's why we find that this global clear may be brought into fruition. And this is why investors during this difficult time explore value stocks versus growth stocks, essentially prioritizing big companies with stable market share and healthy payouts for shareholders over other fast-growing businesses. And in the UK, those problems are about to persist. With this section, now we can find that value of retail sales in relation to volume is getting more detached with the days oncoming. But supply chains aren't broken everywhere. Those are the trends that have been observed recently in Asia. Trade is booming among major Asian nations as businesses rise above the geopolitical ebb and flow that was seen not only in South Korea but also in Japan recently. That's why we may find that those supply chains problems should fade away this on the upcoming year, eventually after this COVID going away. And that's a kind of a projection of where the global PMI may head to. Global PMI and China credit impulse might have this tendency to follow each other, and with this one, in the past, a shift in China's credit impulse was able to signal a downturn in advance. So it looks like we may get still heading to a bottom, but a reversal should get also rapidly. Right now, let's get to market outlook, and with this one, I have for you very very important chart to ponder about. So with S&P 500 earnings estimates have yet to reflect market expectations. Right now there is still a long way to go before reality that will be fairly priced. That's the one of the factors that still haven't made a downgrade yet after those price stamps, and that's the one that is supposed to be observed in the next quarters. So while analysts' estimates for US company earnings have been moderating recently, right now they are still near record highs, and that's why that should be corrected. Recently we also had FedEx warnings about macroeconomic challenges where revenue runs and profit plots. FedEx desire message added to the mounting pile of companies across industries that are painting a grimmer picture of the economy. It also get us more into possibility of downgrading those valuations. Nasdaq locomotives push the market. So S&P 500 PE ratio excluding FAMG. So those are valuations aggregated, but those lower capitalization stocks are trading around recessive territory. It means that this bigger stocks are yet to follow due to this divergence to strengthen. Damped seasonality. So we are right now somewhere around 14th, 15th day of September trade of September, and it means that usually it used to perform negatively. The stock market used to perform negatively, and that get us to one of the explanation of why this situation been so low, and there are a couple of facts due to this seasonality should improve, however, in October. In terms of crypto outlook, we are looking at spend output age bounds, and it boils down to that holders which held BTC in its 7th year moves more than 5,000 BTC, and there could be a strong downward trend in the future. So every single time where those 5,000 BTCs or more been moved, it usually brought a slump in the days to come. This time is not the other, and the fact that the long-term holder moved the BTC means that there will be an unusual price movement in the future. And we also don't find much of a interest on Ethereum contracts. Ethereum merge has dropped some worldwide electricity consumption, but it's still not enough to bring a new narration to push it forward. That's why this interest is that low. So no clarity, no prosperity. We are awaiting crypto regulations. The financial regulators around the world to come together to develop a global regulatory framework for crypto assets, and with those regulations to come, new companies would possibly enter with the regulatory clarity this sector, and without that it seems like there is no other development. Tether ordered to show backing of USDT. It's very important, as during previous years we seen this unended debate whether USDT is backed or not. And with this eventually documents, we will find out how the reality really looks, and that will possibly make those doom theories, those hypotheses that USDT, the biggest stablecoin on the crypto market, is kind of made of thin air, fade away. So we are having our fingers crossed for the positive turnaround. Let's now have a look at market movers section, and with this we are observing an economic calendar. We had housing starts in US, with this one being at a little higher level than it's supposed to be, but building permits has surprised to the downside. That's why those lagging indicators showing will have some problems. Right after on Wednesday we have Fed interest rate decision yet to be introduced, and on Thursday we are awaiting the Bank of England to make the same decision. The expectations from BOE is at 0.5%, as UK's economy has more trouble than the US. That's why this hikes supposed to be a bit more eased. And on Friday we have S&P Global Manufacturing PMIs. As another section, I have trade idea, and that would be the one that is kind of a continuation of what I declared recently. That's nothing has changed. Literally, the very lucrative trades are within Euro USD, and as we haven't reached my suggestive target, I do find right now that after this Fed's decision we will reach an area of this level, as it's to grab the liquidity out of those area of 0.99, and right after bouncing the last bounce out of this this parity area, we will make another rally downwards, another slide that will get us down to 0.95 within next weeks. So that will be very difficult time for Euro USD, but every signs on heaven and earth confirms that is highly possible and also expected. This price action is nowhere near to stop around here, especially as we had those first thrust that has collapsed with a kind of a strong rejection. That's why the market shows it wants to go lower down. Right, so that's it in today's episode. Thank you very much for watching, and see you tomorrow at 8:45 East time.